Hey, what's up guys? Tyson Dela Cruz here. Thank you so much for rocking with me. This video is going to feature our most recent quarterly meeting. And during this quarterly meeting, we went over the market correction that is potentially going to happen here next quarter and the following year. I hope you guys enjoy it.
You know, we're going to see some more volatility in the market. And then, you know, as we move into Q2, Q3 of next year, I think we're also going to see some higher volatility in the market. Snapchat stocks have dropped 83% total. And then, you know, just as a fascinating fact, $2 trillion have been pumped in the U.S. economy. 80 to 85% of all U.S. currency in circulation today has been printed over the last 2 years, which is insane. So this is the reason why the high inflation rates. So what does that mean in regards of real estate? Over the last couple months, I've been reviewing data. The days on market has significantly increased. At one point, days on market and total inventory, let's go total inventory. Total inventory at one point was 0.5 months or 1 month or less of total inventory. Now, you know, we're pushing anywhere from like 4.5 in some areas of total inventory. So that means that there's more available homes in the market. You know, we're slowly transitioning into a buyer heavy market where the buyers are going to be more in favor. Days on market are 60 plus. There's been a decline about 5.4% on demand. The Fed has stated that they're going to raise interest rates a few more times. We've already seen an increase over the past couple of months. They dropped them down a little bit, but they said that they're going to raise them anywhere from 3 to 4 more times by the end of the year. I feel personally, as a whole, home prices will drop anywhere from 15 to 20% across the board in the next 6 months. So not to like scare anybody, but I'm just stating, you know, some facts, and then we'll explain how to pivot. Zillow stated that home prices will fall in the next, in these 123 markets. 780 markets will go higher in 2023. There's a couple markets that Aaron personally pulled up that still show amazing cash flow and still show amazing appreciation. Some of the markets that will be affected by all of this shift will be markets in heavily high dense metropolitan areas. LA, Chicago, New York, Las Vegas, Arizona. These are the markets that have shown the most decrease over the last 60 to 90 days. San Jose being the top at 4.5%, Phoenix 2.8%, Vegas is on there at 1.4%. Have you guys noticed any market shifts personally in any of these markets?
Yes.
I have today, actually.
What did you guys notice or see?
I'm seeing more houses. I went to go look at a house today before the meeting. After I got my new screens for the house, and I was driving along 15th Street off of Charleston. And on that street, there was like 3 different houses on the open market. Areas in my neighborhood, a lot of more houses being sold or on the market. So it seems like inventory is starting to increase a little bit.
Absolutely.
I know. What are you seeing, Aaron?
Based on like the data that I've had pulled here, and also for like Arizona, like the Bullhead area, you know, their average days on market in both areas is increasing significantly. I mean, here in Vegas, we were at one point We were averaging 17 days on market. That's as an average for all priced homes, so very, very low, considering, there's $1 million homes that usually take, 4 to 5 months. So to get to that low of a day on market is incredible. And now we're seeing 60 plus days, right? And this has happened over the course of 2 months. So there's that. And then like with the bullhead market, I know that we saw some data on that before, but we just had some data sent to us this weekend that we're looking at, and it's increased a lot there. It's went to 2 months out there as well, and that one was reduced a lot from what it was previously. So yeah, that's all. And then just if you guys get a chance later, look up CoreLogic just came out with some new data this weekend to kind of go against what Moody's Analytics came up with, looking at overhauled markets. So yeah, it's just very interesting. Just definitely, if you guys have time, research this stuff. Look at like what these analytic programs are saying and what trends are.
I love it. Tom?
Yeah, I saw that same article that CoreLogic put out, but it was put out in Forbes. It came out in my daily feed, and in this interactive map, it was showing Vegas increasing prices 4.3%. Exactly what the time span was on that, I didn't quite catch that because I was kind of being rushed with the family and everything like that. So
no, I believe what you were seeing was actually it was showing the 4.5. That was showing as the overhauled market. So they're showing the percentage. So most of those programs are showing Las Vegas, specifically Las Vegas and Austin, Texas. What I've been reading is those two markets are going to see probably the biggest hit if we do go into an actual, if we do announce a recession. Vegas and Austin are going to be like the hardest hit, is what I'm reading on a few different platforms. So
just those two.
Yeah. No, I think there's more, but Arizona will probably be top of those two.
Yeah, Phoenix is going to be another really big one too, because it's just the places that we've had and somebody explained it to me the other day, and just real side note, like somebody explained to me the other day like this: take 10% of what our prices are right now. That's just fluff. That's where people were overpaying in these markets that in the Southwest region. They're overpaying over appraised value. So when they're going 40, 50K, that's the fluff. Once that comes off the top, now we start at the normal pricing. So take that 10%. Now we're starting at that decrease. So I think we're going to be around 20.
Yeah, and as this kind of trend continues to occur, as more inventory hits the market, it'll take sellers some time to recognize that home values or acquisition prices will be needed to decrease. It'll take some adjustments. It'll take some time. I don't think they'll really start making those adjustments on the seller side until, closer to the end of the year.
For sure.
This is total assets. As you can see, the amount of money that's been pumped into the economy from 2020 all the way up until like first quarter of 2020, all the way to where we're at now at the highest peak. And it's been a slow kind of inclination, and now we're kind of on this downward scope. The administration says that we're not in a recession, that we're still healthy. Obviously, there are ploys to that, simply because midterms are coming up. I feel that that has a part of a play. And I don't think anything crazy is going to happen until that time frame. But yeah, we just have to be aware of these things. We just got to be ahead of the curve on some of this stuff. So in the next 12 to 18 months, I do see home prices will drop across the U.S. Key focus points, just us as an entity, as a company, to make sure that we're not over leveraged, that we're not buying because it's a good deal today. Just because if it's a good deal today, it's not necessarily going to be a good deal in 4 to 6 months, 8 months, even. And I would be almost amped to say, specifically based around, us comping, not even to comp solds, because as we move into the winter months in Q1, I feel that solds are going to be so far off because, like I mentioned, we're 60 days on market, another 30 for close, another 30, 45 to close. So the relevant solds, I think, aren't necessarily going to be an accurate comp. Moving forward, the focus would be focusing on under contracts and actives, like what is currently on the market, what is under contract, and if we're looking at sold, something less than 30 days, because the market is going to trend in that capacity. And then looking at our product versus something that is currently on the market or under contract, how does our product compare to something of that capacity? Like, what's the comparison? I think moving forward in regards of a rehab place or a rehab product, I always kind of emphasize this Costco model of like saying, okay, Costco doesn't always have like the best products. They have medium to medium line products, and they're in a medium price point. They're not the lowest. It's not like Walmart. It's not like going to McFrugal's or anything like that. It's a medium price point and a medium product. I think, as long as our houses are done nice and they're priced accordingly, that is going to be key moving forward. Does anybody have any questions on that?
No questions. I guess just the biggest takeaway is we just have to be a little bit more frugal about, investments into new properties. And if, activities are going down, it's going to mean that it's harder to sell property. And so being frugal in what properties you buy and, how much we invest to rehab sounds like the biggest takeaway you're sharing right now.
And I would also like to add that it's also, and we can always take this all, and that's a good point, Elias. But I think we also should add, like, this also, as long as we're like aware of all these things and super conscious, this actually is like puts us in a really good space to negotiate on acquiring assets, right? So like the positive on this is like, we're going to go ahead and get some stuff for super cheap, you guys, So like, and then when it's time, when rates go down later on, we can just go ahead and refi those, So, we should just, look at the bright side of this.
Yeah, absolutely. And anything like in regards of acquisitions, it's important to note, to have in the cortex of our minds that we are possibly going to have to hold this property. And it might be advantageous for us to hold the property for 12 to 20 months and then reevaluate.
Perfect time to bring in that passive income. Rent them out. You can also get these houses under contract through, subject to their current mortgage and seller financing. So more opportunities on the creative side, not just giving a cash offer or whatnot.
Absolutely, Tom. Like, great point. And that's what Chris and I had talked about when he was in the office is just, you know, as sellers adjust to pricing, it's important for us to, you know, be very well versed in the concept of subject to owner carry, just like Tom had mentioned, and getting a little bit more creative with our options, and then being able to rent some of these things out.
I remember back in 08, 09, it's a little different because it's still a little different, but all we did differently, like in 09 and 10 was, and you hinted at this a little bit, Tyson, was the product that we put out, which had to be top notch. Like we were doing crazy rehabs back then, right? And finally